afternoon. I'm very pleased to open the panel on the alternative sources of capital. We have an interesting mixed up DNA of people involved in crowdfunding, seed funding, VC, and market. And so we're going to start by a small introduction where each of the panelists, Michael, Genping, Mohamed, and Edmund, will talk about what they are doing and the type of financing that they provide to what type of company. And then we'll start a discussion on the trade-off and the danger in taking what type of money from what type of investor and how there is no free lunch. And so, you know, the real cost of the money. But let's start. Tell us a bit about who you are and what you're doing.
Well, I'm from the Singapore Exchange. Obviously, I'm in the listing department of the exchange. We have a board for fast-growing companies, which is the Catalyst board. It's a sponsor-supervised board, very much like the AIM market, without any quantitative admission requirements. So the companies that come on stream tends to be growth companies that are looking for growth capital. I also look after companies from the digital or technology sector, those that are looking for access to capital in our markets. And the third thing that I do is to also look at a solution for companies that are not quite ready for the public markets but are looking for growth capital. So we have collaborated with some partners out there to form a platform. We would like to think of it as a venture capital platform called CapBridge, which basically seeks to fund company more around the Series B stage and beyond.
So you're taking those guys' business?
No, they are at a different stage of their lives.
Okay.
So
because I thought that their dream was to work with you and to IPO any company they were going to fund.
yes, so we'll take them
So
further
it's still
along.
the case?
Yeah.
Okay.
Yeah.
So better move to the other side. Yeah, so basically, Vertex is a VC subsidiary of Temasek Holdings. Generally, we focus on Series A round, B round, and a little bit of later stage rounds. We are a global fund with office in China, Israel, US. So I belong to the South Asia team. Generally, the South Asia team look at the general TMT sectors, which include both consumer, enterprise, software, internet solutions. I guess recently more looking at fintech, a lot of fintech. I noticed the last panel was about fintech. We also kind of look at what kind of options startups have nowadays to raise different type of capitals. Later we can share. So our investment size is averaged by $2 million to $15 million US. Our most, I guess, some of the famous investment in this region is Grab, Rebounds, like PanSnap.
Interesting.
Thank you.
Michael, you're running a crowdfunding platform.
Yes, as a name funder here, we actually are part of the Smart Nation initiative. We're a little bit different. We're a company in the new economy. We actually seed company from after seed capital pre-Series A, typically 300,000 Sing to $1 million Sing. That's what we do in that space. We find that this space is a little bit in a vacuum at this point of time. Most people will have a good idea, get grant from government, but then they don't know what to do next before Series A come in, or even you know, if they can list the company or that. So we wanted to play in this particular market, and we are fortunate enough to have the first license from the government, and that also makes us really responsible for what is going to go forward with this initiative. I think this is going to be a very interesting marketplace for all entrepreneurs in Singapore and around the region.
Excellent. Edmund, finally, you have a seed platform.
Actually, I don't know what's actually the delineation between seed and crowdfunding or even Series A. Essentially, I invest anything from $100,000 to $2 million. So does that mean I actually cover the spectrum of angel funding all the way to Series A? So it depends on the valuation, depends on the company. I think it's quite uncommon in Singapore to do that. I find that actually it helps the company survive a lot longer and to actually get the most value from the next round. So I think my fund, I have a few companies that are people, I think some of you may know about them. They are like Shopback. They have grown from 0 to about 100 people today. They just received about $10 million funding about 2 weeks ago. I've got another company who is called PetSnap. They have grown from 0 to about 300 people in the last 5 years, 6 years. So it depends on, I suppose, the strategy each of us have. It depends on a funding, what I call strategy. So I don't try to differentiate between seed and angel funding or Series A, because it depends on how well you actually manage the company and how it progresses. Yeah.
So we have this continuum, however, wherever it starts, from seed, crowd, VC, growth, and then the market. Where do you see, are there any tension between the various stages, and what's new, and where are the actions? So it seems from the outside that the only new thing happening on the financing world, which is a very uninnovative world, has been the crowdfunding. Is that true?
Sorry, again, what's...
In terms of what is new except crowdfunding? I mean, crowdfunding sort of came into reality, I would say, probably 5-6 years ago. And that has been the main development of the financing industry. Would you agree with that? Why did it take so long? And where is that going? Is the crowdfunder moving upstream to bigger and bigger and bigger round, becoming VCs themselves, or becoming exchanges themselves? Where do you see that going?
I see. First question is about why did it take so long? I think we are operating in a financial world, which is, of all you know, is regulated by different regulators in the world. So naturally, it will take a little bit longer for any industry to develop in the financial world. But we see a lot of positive moves or basically regulatory changes around the region and in the world that facilitate this to happen. We basically think it is a new, whole new industry that is going to happen in the next 5-10 years. That is complementary to the existing financial industry that we have. However, we think that the growth rate of the new economy, financial industry will be slightly faster and different from the existing ones. The second question is about moving upstream or downstream. I think it's a little bit polarized right now. I cannot generalize where they are moving upstream or downstream. I think essentially it provides a new way of gathering capital. If you may say that we change the game a little bit. You know, previously when you are a business owner, for example, you go to your VCs and angel guys and all that, and you know, please, you know, listen to my plan and all that. So, and then if you're a VC, then you look for your own people, you know. But we provide a platform, so everybody will be there. The investors and the entrepreneurs will be there. They look for projects or investors themselves, and it's a little bit of a transparent way of doing things.
So is transparency a good thing from the founder, the CEO perspective? Because if I go and see somebody running a seed capital fund, if I go and see somebody running a VC firm, the big value is that I can stay private and I can avoid any transparency in my business until it's needed. And so is transparency generally a good or a bad thing? Because it doesn't have to be a good thing. You know, and if I'm not transparent, my competition is not going to have my information. And we are involved in a lot of discussion where, not with your platform, but with other type of platform, where the core of the discussion is, transparency has a price, and do we want to pay that price now? Later is another thing. But for early stage venture,
but when you talk about transparency, really you're talking about transparency in the context of transparency vis-a-vis your shareholders. So at every stage of your fundraising life, transparency vis-a-vis your shareholders, I think is a necessity, right? When you're in the public markets, obviously, you're raising funds from public, and therefore it becomes very important for you to be transparent in that context. In the private market context, or in the VC context, then it should be transparent to those who have invested in your companies. So I think it's the same conceptually, but you have to apply it into the different environments that the companies have raised funds. But I also like to just comment on your earlier point just now. In terms of fundraising these days, is crowdfunding new? Apart from the regulatory changes, I think just to add on to that, if you look at the companies that are coming on stream that are being built today, characteristically they are different from the companies of yesteryears. These are companies that frequently utilize technology, tend to have a very, sort of like global ambition, and therefore the race to get to their endpoint becomes very steep, in that they would need capital far sooner than the companies before. It is no longer viable for you to think of it as growing organically and incrementally. You have to somehow accelerate that growth, which means that companies of today would need capital far sooner than companies of yesteryears. And they would need that sooner than before they are even ready for the public markets. So when companies need that capital and they are not able to generate profits yet, but they need scale, then the question is whether public investors can stomach them, or less sophisticated investors can stomach them. And therefore, I think this is one of the reasons why, if you look at it, there is a lot of interest generated by VCs and PE funds, or even angel investors who understand the space better and who are able to invest and take risks.
Yeah, because the big question is, can I engage my investors, whether it's a person, a general partner in the fund, or Joe Schmo, the retail investor, into a discussion which is not open quote, when are you going to be profitable, end of quote, which is very often the question that the retail guys are asking. And it seems that, so historically, a lot of value I was getting from a VC is a relationship with a general partner. And I was not so much taking Vertex money, I was taking you and your money, but you as an advisor that was going to help me in the next 3, 5, 7 years. Has that changed? And what's happening both at the angel and at the VC level of this very tight bond between the investor and the CEO? And do you see that evolving or not? And is that being disrupted?
Yeah, I guess we are more of a traditional VC, believing like the traditional VC's philosophy, trying to select a few companies and help to build the company along the way. So what you mentioned just now is really true for us. So when we invest in a company, we want to build a relationship with that company and maybe build together in the next 5 to 10 years. But on the other side, we also notice that there are other partners in the ecosystem are adding value at the different stage of the companies. For example, some come at very early stage. So recently, let's say we had a recent investment on the cap table. There are quite a few small shareholders. So we engaged discussion with them, but after we came in, we kind of try to talk to them, say, can we work together to consolidate the shareholder table to make it easier for the company's growth in the long term? And some angel investors understand, some angel investors decide to stay with us given the kind of value we are going to bring in. I also want to share that on the other further extreme, there are some other examples. For example, just currently it's ongoing. There's something called the DAO on blockchain. It's distributed autonomous organizations. It's not a legal entity, but they managed to raise 120 million as of this morning when I checked. It's fully transparent. There's no single JPLP type of relationships, but that's kind of like the innovations the internet is trying to bring. But I think in the long run, such kind of organizations, VCs, angel investors, and the crowdfunding platform will coexist and just to work together along certain directions and make it work.
A lot of it takes today less money than it used to start a company. And it takes today more money than it used to scale a company. And so does that create an interesting opportunity for the angels at the beginning, because you can actually create a lot of value with much little money than you used to in the past? Are you seeing that?
I think essentially, I don't know, I like to say the thing is every fund will decide on actually the strategy. If a company takes money from Accel-X, then I will work with the entrepreneurs quite a bit and decide actually how much money they need for at least an 18-month duration. That I think 18 months gives you a window to develop if there's a product, and 8 months more to raise potentially a Series A if you have to raise a Series A. Other than that, you have to decide whether you want to actually, do you want to extend the duration where they can survive in a longer term. So whether they raise more money or not, it depends on, I think, the fund or the angel fund to decide, and then say actually how much the company in the real sense. And that's actually quite operational, and you do have to work with entrepreneurs quite a bit on that.
Okay. Let's look at some of the questions that are being sent our way. So I'll start with how are crowdsourcing platform affecting VC today, and will VC be Uberized?
What? Sorry.
Sorry, I didn't hear the
Will
question.
VC be Uberized? So, or the crowdfunding platform basically moving up and slowly eating, as a traditional case of disruption, described by Clayton Christensen, where this stuff was really low-end, low performance, and now basically it's going to do everything that everybody else is doing.
So maybe I can just try and answer this one. I don't know whether it will be Uberized, but what we have done in the Singapore Exchange is we've realized that as companies need funds before they're ready for the public markets, that exchanges are getting disintermediated in some ways, and our relevance is being diminished. So one of the things that we thought about was how could we increase our relevance, and we decided that we should develop a platform to allow some of these companies to gain access to capital before they are ready for public markets, but not just access capital, but to give them smart money. Basically to get them guys who can help them grow quickly, and then while they are on that platform, ready themselves for the public markets. So we see it as a developmental pipeline. We see it as a platform to cultivate these companies. So what we did was we established a platform which is called CapBridge. It's also licensed and up and running. And what the platform does is that while it onboards companies on the platform which fulfill certain criteria, it also has a base of investors, institutional and accredited investors. Using algorithms on the platform, we will match a profile of investors that are suited to the companies.
When you say profile of investor, how do we ensure that the people that invest in the crowd platform understand the risk that they are taking?
So
because
these platforms...
the company can just vaporize
Yep.
in a matter of weeks.
So
or not.
when you talk about crowdfunding in the Singapore context today, we are talking about institutional and accredited investors, high net worth investors. We're not really talking about the mom and pops, because I think from a regulatory standpoint at least, the comfort level of whether they understand the risk of early stage investing is not there yet. It is a more risky area of investment.
Okay.
I think we certainly would like to be the Uber of VCs, but I think whatever this industry will become is still the choice of the customers or investors and the market itself. Basically, I don't see that traditional source of funding is going to go anywhere in the short term. And as my panel colleagues has told us that we need each other to basically work in the marketplace. However, I think it is interesting to have a new platform to certain investors and also entrepreneurs that they can connect in a different way. And this is not the result of we thinking about it, it's the result of where the market is going. And basically, I think to respond to your earlier questions that whether full transparency helps, I think certain transparency will help. And this is where the market is going that we believe. And we are not saying that you are totally transparent as in your patents and all that. We actually require the patent or the intellectual property of the company to be stored in the company before we do funding. Okay. So you have some kind of patent, before you move into that.
Now, one last question on crowdfunding before we move, but you were going to say something.
Yeah. I guess as we see, we actually really love all the crowdfunding platforms. But I guess each crowdfunding platform actually adds a lot of value to the startup community, also to the whole VC value chains. For example, Kickstarter, some people call it donation-based crowdfunding because people use it as a way to market their product, and when they achieve certain tractions, actually they come to VCs, make our work a lot easier. There are other equity-based crowdfundings, usually the successful ones, they tend to focus on certain segments, actually generate a lot of deal source for VCs, also basically make our life easier. So I won't say it's going to woolenize VC, but it's going to generally enrich the VC, the startup value ecosystems to make make everyone's life a bit easier.
Is there anything geographically specific to crowdfunding and early stage in Asia versus Europe or versus the US? I mean, obviously the market seems less mature here than it is in the US. So can crowdfunding work here or not?
We are in the business. I truly believe that it will work and it will grow and it will actually expand in Asia. Just because of a simple belief that there's a lot of entrepreneurs in Asia, and the Asians would like to decide some way of their own investment. So if we provide an alternative source of funding, then you will say, okay, I wanted to invest in this company, that company, and another. You may end up with the next Uber. If we all believe that Singapore is going into the next phase of growth, and we will see companies like that happening through Singapore's market, then there is an opportunity that somebody here or in our investor base will end up with a certain percentage of these kind of company in 5-10 years' time.
So let's talk about Singapore. There is a saying that there's a lot of money around, but not any really interesting good project to invest in. Would you agree to that? And is that changing?
Sorry, say it again.
A lot of money, no good project for investment in Singapore. Is that true?
There are a lot of... Is that a question?
Yes.
The sound system is not very good, isn't it? Yeah. There are a lot of good ideas I was just talking to some people who actually come from overseas just now, and we were talking about the quality of deal flow in Singapore versus the region. And I think there's some semblance of agreement that Singapore still got actually better, as far as Southeast Asia is concerned. Singapore probably got a more, quite a good quality of what I call deal flow. And as far as I'm concerned, because I only do Singapore investments, there are a lot of good deal flows because the companies I have are doing quite well.
So you don't buy that?
Yeah. So I totally agree, yes.
Excellent.
I think I have something to add. I think we do not lack of good ideas in Singapore. I mean, our universities, our government, or also private enterprise has actually helped to source around quite a number of good ideas. Traditionally, we do not have enough smart money or good channels for them to go into the investment to make this idea work. You know, so as this is changing, then we will see also people with great ideas moving forward. And if we are all thinking that okay, these are a different kind of investment, and we accept that this is a way forward, or this is one of the way forward, then we will create a new space for this marketplace, and it's going to be interesting.
Okay.
Let me just chime in a little bit. I think while it's a bit harsh to say that there's very few good ideas, there's quite a number of good ideas out there. I think we could do with a little bit more original ideas out there as well. Clearly, I think relative to the more sort of like mature countries where innovation and creativity have been going on for a long time, like the US or Israel, we have still some way to go. But I think we are getting there fast and making good progress, and we shouldn't run our entrepreneurs down. Every year you have quite a number of guys coming through to the market with very good ideas and great potential.
Okay. Now let's talk about the early stage project. So two interesting questions. The first one is, what is the best way to get funding if you have an early stage project? And let me add to that, isn't the best way not to get any funding? But that's sort of my twist on it. So, if you had an early stage project, how would I get your money?
How do you get my money?
Yeah.
Probably not, but yeah, okay. Well, firstly, what you do is actually write to me or to the website I have, and you give me basically a set of slides to look at and your business idea. And if I'm interested, I'll call you back. Not interested, maybe not. It's very simple.
So it's all relationship based?
Sorry?
It's all relationship based.
It's not relationship based. It's actually very objective. I'm not here to basically. It's not my father's money or whatever it is. I manage a fund, so it's purely commercial based. Relationship is important when I invest in a company. Then I have to know the entrepreneurs very well. And in fact, some of the CEOs I have, I make sure that I know their wives as well.
Now, everything we've talked about was about equity investment. There is another end of the spectrum, which is debt investment. So one question is, how to convince debt funding at the seed stage? What's your view on that?
Well, normally VCs are what I call, in Singapore, there's a parlance called kiasu, right? So what we all do is basically, instead of putting all purely in equity, we call it a convertible note, right? It's a convertible note to actually basically have a, just in case the company go into liquidation, you have a first bite of whatever is left of the money on the table, but that normally now doesn't happen. It's just basically what I call a investor wrong mentality. It doesn't matter whether it's note or actually it's equity. It's still very high risk.
I think for us it's a little bit different. I think we don't decide on debt or equity. Basically, it's as simple as the entrepreneur put up a video and a pitch deck. You put it online, and the investor will decide, whether this is debt or how much equity that they want to give. So it's a little bit different scenario for us.
I think usually actually it's a startup who prefer convertible note, convertible debt funding instead of VCs. Because startups are more afraid of dilutions, right? You tend to postpone as a percentage of discount to Series A type of things. But typically early stage investors prefer equity because that's how they get rewarded later, right?
Yeah, we have found that this is a question that the founders ask us very often, and they don't understand that from an investor perspective. Why would I take equity risk and debt return? And what that means is that if I loan you money, I'm going to make, if everything goes well, I'm going to have a certain return, 5%, 10%, 15%. But fundamentally, when you loan some debt to an early stage project, you're taking an equity risk, which is if it doesn't work, you'll have nothing. And so why would I take a fixed, fairly low debt return for an infinite equity risk? And basically, from an investor perspective, you know, it doesn't make any sense. Now, let's go back to the life cycle. So, you know, we have a project that's going to go seed, crowd, venture. Eventually, if everything goes well, it will end up in the public market. Is there any way to go back? Is there any way to go out of the market? Is this a concern that people have? Because obviously companies go up and then they go down and then they go up and there are cycles. So when is it the right time to take your money, the public money, and once I have taken that money, is it like a drug where basically I can't get out of that drug? Is there any way out of the public market?
Well, when someone decides to list their company, we were having this discussion just now, and I liken it to getting married. You're basically deciding to start a life as a different entity in the public space. And to take yourself out of this equation, just like most marriages that don't work out, it becomes a little bit difficult when you go through the divorce. So in the exchange context, we call it delisting, which means you have to take out your minority shareholders, and there's a price to that. But some of these things happen as a normal, you know, event in a well-functioning market. As valuations go up, people bring companies to the market, and as valuations go down, then it becomes cheap for them to take it private. And we have seen instances of companies that come into the market at high valuations, delist at lower valuations, only to come back later when valuations go back up. So it's a healthy thing.
Okay. I want to finish by talking about expectation. Taking somebody's money is like it's a long-term relationship. It's like a marriage. So it's important to understand the return expectation of the guy or girl on the other side. So can you please tell us your return expectation when you invest in a project? What's your horizon? And then is there such thing as an expected return? And what are your expectations?
Well, if you're running a fund, every venture fund got a lifespan. So theoretically, it's between 6 to 10 years. So within that lifespan, you have to exit your investment. So whether you are looking at a 6-year fund or 10-year fund, as a what I call early stage investor, you are expecting that at least one investment will return you at least minimally 10 times, and the rest maybe 3 or 4 will return you hopefully about 2 times, and then the rest can die. It's okay, right? So that's how you recover back your money. Only your money, and with a very small return. If one of your investments become like a Google, which I always hope it will be, then you are looking at least 100 times return. That would be fantastic.
Okay.
Yes, I think there's two lines of our business. One is equity, and one is that I talk about equity, which is similar to what Edmund has said. I mean, if an investor invests and they choose the investment, then they will have maybe 5, 10, 20 investments. The return profile will be similar to, we hit a Google or Singapore or Uber or Singapore, then probably the return will be 100x. And some of them will go south, and you will not have any returns. However, for that deal, that is decided by the kind of company who raised money and how long is the tenure, and normally it is higher than bank deposit, I would say, and basically in the regions of maybe about a few percentage to around 10% per annum. These are the return expectations.
For us, typically it's 5 to 8 years, and looking for about 10 to 20 times multiple returns. And I guess convert to fund level IRR probably like 30 to 40% of on annual basis.
I just want to stay with you for one last question. What would be your short-term and long-term advice to somebody that has just taken VC money?
Sorry?
What will be your short-term and long-term advice to a CEO that has just taken some Vertex money?
Short term and long term, would you give? Short term advice, try to. I guess like I just finished an investment recently, so I do regular drinking sessions with the CEO. So we do have a lot of short-term advice. So our short-term is more like what I mentioned just now. We look and try to build companies together. So short-term advice for startups who taking money from any VCs is like try to see, can you really sit down with that VC on weekly or monthly basis, take a drink and discuss about business, how to build business together, view them as co-founder instead of just a pure investor. Long term is any startup will go multiple up and downs. If you read every great startup stories, there's a lot of really, really bad times. So you need to say like, can you really work with this VC over that 5 to 10 year period? When you are sick, will they beside you? And when you are really having a hard time, are they just pushing you for the monetary return, like to return the money they put in, or they are more concerned like, are you going to come back again to the business or to your next startups? So try to look for the smart money. Try to look for friends instead of trying to look for capital.
Okay. Gentlemen, thank you very much. I think the time we had is gone. If you have any question, please come and talk to the panelists after the panel. Thank you.
Thank you. Thank you.